How do interest rates change real estate returns? Why do rate cycles create distressed opportunities?
Uh, well, I mean, when you use leverage on an asset, so let's say, you can leverage and interest can do good and bad. And so when you've got a market like anything that was not the last 3 years, where you've got single digit interest rates, really sub 5% interest rates, then your cost of debt is far cheaper than the cost of private capital. And so, let's say that you're running a equity stack that you're giving a 10% preferred rate of return, and you're then splitting profits 80/20 over and above that. Okay, fantastic. Well, if you've got debt that is 5% and you're buying an asset that is going to produce with 60% leverage, um, that's at 5% debt versus 80% leverage at 5% debt, you're going to get a lower cost of capital on that extra 20% going from 60 to 80% leverage. Because now instead of paying the 10% pref and splitting 80/20 on all the profits, you're using cheaper cost of capital, i.e., 5%, all the way up to 80% of the capital stack. And so now you can use less expensive money to generate a higher overall return. However, in the flip circumstance, when you've got maybe a variable interest rate loan or you've got high interest, then you want to use less leverage because that interest is going to cut into more of your overall profits. It's going to cut into more cash flow because you're going to use more cash flow to cover your debt service, and or if you're buying an asset assuming negative cash flow after debt service, which a lot of California investors do or New York investors, where they know that the value of that dirt is going to appreciate faster than the cost of their debt, but maybe the asset doesn't cash flow enough to cover the debt. Well, then they'll raise enough money to cover the net negative debt service long enough for them to hold the property long enough and then turn around and sell. So, if you're using up more of your cash flow on debt service, that's obviously going to eat into your returns to some extent. And so a levered IRR versus a non-levered IRR. The levered IRR is always going to be stronger. That does not mean it's less risky though. A levered return where you're using cheap cost of capital with leverage comes with pros because you can generate higher returns, but the cons are it can also negatively impact your investment when interest rates get too high on like a variable interest rate loan.
Yeah, Brian, you got any thoughts there?
Yeah, I would just say because we've had this question come up quite a bit recently, and that is, how do operators deploy rate caps in the environment that we've been in over the past couple of years? And look, everyone can be a Monday morning quarterback and say, hey, with rising rates, it did make sense to deploy probably more aggressive rate cap structures than were done previously, and anyone could probably say that. I think it's important to look at real estate cycles over longer time periods versus just the past couple of years. And the reality is, if you work with an operator or you're an operator who exclusively deploys rate caps, I look at that as analogous to a healthy 25-year-old purchasing life insurance. It may work, and if you need it, it works great. But the chance of needing it, again, over longer cycles, really can be a drag on your overall returns. And so, hindsight is always 2020, but you have to look at this in terms of 5 to 10 or even longer cycles. And generally working with operators that deploy a mixture of assumable rate notes, some variable rates, and some variable rates that have some rate caps can actually generate greater wealth and greater returns over longer time periods than exclusively deploying rate caps in environments like we've seen in the past couple of years.
So, Brian, you
So
talked about rate caps there. Obviously, that's a bit of protection against interest rate movements. There's, a few different things you can utilize between a rate cap, prepaying interest, interest reserves. Kind of give us a high level explanation to the public of what a rate cap is.
Yeah, so in general, if you lever an asset, it's really no different than if you're an individual investor and you buy a variable rate note on a home. That note may come with a certain percentage. Let's say it starts at 6%, and then after a number of years, typically after 3 years, the bank reserves the right to adjust that up, and that could go up a certain amount. Maybe it goes up 3%, so now you're looking at a 9% rate. Maybe it goes up more than that after another couple of years. So essentially, you are paying for insurance to ensure that that rate doesn't increase beyond a certain level. So you can protect your overall net operating income. And in my example, if you started with a 6% rate and you decided to deploy a rate cap to ensure that it didn't go above, let's say, 8%, that can protect your net operating income should we see a rise in interest rates. Now, what if interest rates don't go up? Well, you've essentially paid the bank for that insurance and you're not using it. So that money is not free money. That money is essentially a drag
I,
on
I've
your
got an
overall return.
example. Yeah, I've got an example on that. I mean, we bought on a loan that we initiated the loan at 3.1% interest, I believe. We paid $250,000 for a rate cap, and that rate cap kicked in at 6%. Well, interest rates went well above 6%, and for well more than 2 or 3 years, that rate cap in essence paid us over $2 million. I think 2.4 or $2.6 million, and it cost us $250,000. So huge, huge opportunity there. On the flip side, we also bought a rate cap at $1 million that never exceeded the interest rate that we set the rate cap at, and so it never paid out anything. So that one cost us $1 million, and so you can go both ways with that. But I think one other thing that really interest rates affect in real estate markets and their returns is refinance risk. Most operators are buying a property with the intent of executing some business strategy that's going to increase NOI. And in order to do that, typically you're going to have either distress on the asset or you're going to force some sort of vacancy for a while to turn units. All the while, your property is not going to be stabilized. So typically, if you're going to have a non-stabilized property during a business plan, you're not going to get traditional lending. It's going to be bridge financing. And your expectation is to get out of that bridge financing with a permanent refinance once you stabilize. Well, if interest rates go up, and in circumstances like over the last 3 years, we saw interest rates more than double and in some cases triple. And when you go to refinance, the amount of capital that you're getting out on the new loan is predicated around what your NOI is and how much that NOI can cover the debt service. Well, if the new loan that's being refinanced is at 8%, and your original loan, when you originally underwrote it, was at 3%, and maybe you underwrote to go as high as 6%, but now you're at 8%, that additional 2% applied to the NOI is going to affect your proceeds significantly, and you're going to end up not being able to refinance enough to take out the original loan. And that's what puts operators in scenarios like what I'm talking about that we have now, where there's huge opportunity in real estate, because now all of a sudden they've got a property that they're in at 21 million dollars. They've got a 15-16 million dollar loan, and they're only going to be able to refinance $12 million. Well, if they don't have $4 million liquid, they're going to be in a heap of trouble. And that's what we've seen tons of now. And so the bank ends up stepping in and taking the asset, and they've got a $14 million loan that they're happy to walk away with now at 10, 11, or $12 million because they've had to take it back. And so now an operator like ourselves with liquidity can step in and negotiate that discounted payoff with a lender.